Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with a very special edition of our weekly broadcast, the last week in Mortgage Today, kicking off our 12 days of TMC event, which will span the Tuesday through Friday of this week and the 2 weeks following it. 55 interactive lender-led sessions, 12 awesome keynotes. We've got Dave Uiho from CFPB following Jason and I here at the bottom of the hour, and all kinds of great content, prizes, a lot to chew on these next 12 days and the 12 days of TMC. But we wanted to kick it off with our kind of flagship show that we've developed throughout the course of the year, the last week in Mortgage Today. And who better to kick it off with than our first ever lender member and the chairman of TMC's Lender Board of Directors. One of many cool things about TMC, our board of directors comprised of our lenders. The CEO of Panorama Mortgage Group, Jason Madiedo. Jason, thanks for joining me, man.
Thanks, Rich. Appreciate it, as always. Glad to be here.
And we had some breaking news, already a lot to talk about, but some breaking news just being released here a couple hours before the show started. The conforming loan limits officially raised by FHFA from 548,250 to 647,200, pretty much exactly an 18% increase, which if you look at the FHFA recent home value numbers they released and pretty much any other broad national home value statistics that have come out recently, that's what home values are up year over year. It's kind of crazy to say that. Home values nationally up 18%. As such, FHFA raises the Fannie Freddie conforming loan limits to 647.2. In some high cost areas, you can go as high as 970, 800. Who would have thought that here in 2021, you'd be able to sell almost $1 million loan amount to Fannie and Freddie?
It's crazy, but much needed, right, Rich? I mean, if you think about it, there's not a large market, at least in our world, or an easy market for loans that are jumbo or viewed as jumbo, especially when you get into certain markets that have had really crazy appreciation rates, a little scary appreciation rates. But so I think this is great. Probably much needed going into 2022 because we're trying to figure out, I think the whole industry is trying to figure out how much volume are we going to be able to do. We're pretty certain that rates are going to continue to climb. Refis are going to continue to decline in terms of percentages at large and pretty largely. And then purchases are going to sort of be the new thing, or continue to be a bigger thing this year with a little bit of growth there. So this is definitely much needed to be able to do standard mortgages. But where my mind is at right now mostly, and I'd love to see the chat and see who's in the same boat, is since this is the first of the 12 days, I would say on the first day of Christmas, my true love given to me figuring out how to budget for next year. So that's I think we're trying to figure out. This is increased loan limits are going to allow us to do a few more loans, especially in these areas where they're high cost that are traditional mortgages. But how many will there be, and how much will appreciation? Will it really flatten out next year? How competitive is it going to be from a margin perspective? I think we're already seeing so far, that margin pressure happening, and I think we're also seeing the recruitment pressure. Obviously, this is the season, another season for recruiting, and high dollars going out there, probably rollover dollars from 2020 going out there to recruit volume in and budget and figure out, how do I budget? I think I know for us, mad scramble, outsource, AI, robotics. Like, how do we just continue to get into this, because the volume may or may not be there. We're sort of betting conservatively, very conservatively, and how do we really reduce costs? So that's where my mind is at. Great for the really good for loan limits. We can do a few more loans, but I think we should be focused on cost on the first day of Christmas here for 12 days.
Great insight, and so much there I want to dig deeper on as we get into the show here. And so much for leaders like yourself to weigh as we head into a new calendar year. We were kind of talking before we went live, a year ago at this time, it was just so busy. We knew at least the beginning part of this 2021 was going to be busy. The year ahead of us, much more uncertain, and no industry I can think of that has more variables that CEOs like yourself can't control. If it's government policy or interest rates that have a huge impact on just volumes in general in our industry. And more recently, this last year and a half, the pandemic that will seemingly never go away. This latest variant is wreaking havoc currently last week in this with financial markets. A lot of rates dropped a little bit, the mortgage rates, off the news last week that started to break about some of the things that were happening. And now there's speculation that, the Fed could delay their scheduled rate hikes and, potentially back off some of the easing that they had previously noted on bond buying and treasury buying. So, all the things that you're weighing, you add that into the mix. How do you see just, I guess, the pandemic in general impacting things? I mean, in my mind, just the fact that there are all these new variants will naturally keep Fed policy a little bit more dovish than otherwise, and in theory, keep rates a little bit lower. But I think we'll also continue to increase the value in consumers' minds of their houses, which I think we saw a big lift of that because of this pandemic. Companies that no longer going to mandate coming back into the office. Your thoughts on just the pandemic, where we're at with it, and how you look at that as a leader?
Yeah, well, so I think we all make our own decisions, right? As running mortgage companies, and I feel like for me, it's the closer that I have the feel of the pulse of our folks in the markets that we're in. So from the pandemic side, you also heard the president say that we're not going to go back into a shutdown, and I really believe that this country would not accept a shutdown. Do you have to wear masks? Are there going to be certain mandates and vaccinations and all of that? But that is becoming somewhat normal. So I think some of this, what we're seeing really is knee-jerk in a few weeks, but you're also seeing reports that in 2 weeks, they're going to tell everyone how effective the vaccines are against this variant. And I fully believe that they're going to, if it's not, they're going to adjust it and everyone will get a booster. So I don't feel like it's going to be as impactful in next year. I think there's a little short term. I think the media, needs the story. And so these short term bursts and blips happen. But I think in the long term, we're going to go back to whatever our new normal is. And it's already on its way. I think that's how the pandemic is going to play out. From the value of homes, I think that's why when you look at whether it's Fannie, Freddie, or MBA, or the average of all three in terms of what they are forecasting, they are forecasting an increase in purchase volume by about 10%-ish or so, which we agree with. I think with what we believe is that we're going to see some fence sitters, some sellers who couldn't sell during the pandemic or are afraid to sell during the pandemic, and a little worried about the market getting away from them to maybe get off the fence and sell their properties. And I think you're starting to see that in certain markets where inventory is on the rise now. There is the craziness of offering 50,000, 100,000, 20,000 above asking. That hasn't tamed off yet, but we haven't seen the rates fully rise. And I find it hard pressed to believe that they're going to continue to press down interest rates with the direction of inflation. Maybe if we see the bottlenecking sort of free up, maybe that'll help. But I don't know, inflation's here to stay. So I think rates are going to have to go up, or we're going to go into some sort of big recession in a couple of years. That might happen anyway. So what does that mean for us? We've switched. We were 40% purchase in 2020, which we've never been, maybe 45% purchase in 20. We're 75% purchase today, which is where our sweet spot is. We're really, really focused on that. So we can go into that 2022 with a strong purchase mix. And we think that we're going to have a tougher go at it. But we do think that there is some possibility of the fence sitter sellers who don't want to lose out on the opportunity on all this equity that they're sitting on, and buyers worried about interest rates going up and wanting to get in now, especially with affordability being such a challenge, that there is some positive side. I just think that we got to go into it positives. We're going into it positive from a purchase perspective. We think there'll be more inventory. We think that's going to, the buyers are going to want to get in even more aggressively, to your point, Rich, because they want part of that American dream, and they don't want to be caught, in an apartment, in a 600 square foot apartment, if it ever happens again. But I think that we got to be really, really tight. I mean, tight on manufacturing costs as much as we can be, because we'll see after the first quarter where the market's really going to do, I think.
Yeah, a lot of great points there, and I want to get into the manufacturing cost side of it. But I think you noted, like, people coming off the fence. We're starting now to see some evidence of that. Late last week, pending home sales for October was expected to be flat from September to October, up 7.5% nationally. That's a huge outperform. If you dig down inside the numbers in the Midwest, pending home sales were up 11.8%, up a little over 8% in the South. So some of the stuff that you've heard people talking about, maybe some of the population migration, starting to see some evidence of that. MBA also reported, I think it was the week of November 15 to 22, purchase applications up 5%. Week over week. That's the biggest jump in purchase apps we've seen on a week to week basis overnight. And I think just anecdotally, you're starting to hear and see and feel it, that a lot of what you just talked about is starting to happen. Those people maybe that wanted to buy a house in April or May, and oh my God, like, oh, this is crazy. How values are going to come way back down, and the bubble people, and I'll wait till that happens to get my house. And I think now those people are like, man, I got to get a house. And some of the people that own a home, I have now seen their homes appreciate another 6 months from the spring, when values and bidding wars and all that was a big talk. I think you could see a really big winter for just home sale and home purchase activity, and I think you're starting to see some tea leaves on that now.
Yeah, our originations have gone up month over month for the last 2 months, and that is full applications, not leads. We look at leads a little differently. And so, and it's mostly purchase. And I think that's you're spot on. I think people are looking at the market saying, I got to get in. And others are, like I said, I got to not lose out because inventory is slightly creeping up in certain markets. And I think that's going to continue to happen for the rest of this year and 2022.
This is the last week in Mortgage Today, a very special edition kicking off our 12 days of TMC event. Today and the 11 days following. So just really incredible content in the afternoons, Eastern time, for our members, Tuesday to Friday through Friday of the next 3 weeks. And as always, any comments, questions, thoughts anybody has, please feel free to drop them in the chat or the Q&A. I saw we've already had a question come in there about how the new variant has affected rates. And Jason, you're closer to the ground than I am, but I think last week we saw rates drop 15, 16 basis points, a 30-year fixed rate, and have stayed pretty flat, I think, since then.
Yeah, but I think the real question, again, I think this is we're saying knee jerk, but I think the question is are they going to back off on buying mortgage-backed securities by June or not? I think that's the real driver. As of today, it seems like that's not going to really change, other than the last week or two of what we're seeing in this new variant. But I think the country is generally prepared for that. I think people are prepared. And I think we won't know. I mean, it's just too hard for me. I'm not an economist. It's just too hard to tell. But I think it's safer, maybe just being conservative, to go into this new year saying interest rates are going to go up. The variant may not be the driver of that, but or staying down. I don't think variants, and I don't think the pandemic's going to keep rates down any longer. So I think we should move forward like they are going to move up.
Switching topics from the production side of the business to the expense side of the business, you've mentioned a couple times, just as you're assessing your budget for next year and how you kind of chart the course forward for your company, how to handle, your manufacturing process, the expense side of the business. Who would have thought, if we'd be sitting here in December of 2021, that our business would still be as human as it is, and having conversations like this 3-4 years ago and starting to see some of the first waves of automation tools, a lot of different factors, I think, to that. The latest just being the pandemic. It's been very hard for lenders to implement new things these last 18 months because of how busy it's been. But what I keep hearing from leaders like you, and you just said it, is right now that is really top of mind for you, trying to make sense of if it's automation, outsourcing, ways to use, document recognition and automated intelligence and artificial intelligence to help your manufacturing process. It's top of mind issue for you right now as we get set to go into the new year.
Yeah, I mean, I think if anything keeps me up at night, when we're talking about rates or pandemic or volumes, if it's how expensive it is today to manufacture a mortgage. Hi, Julie. Did you know that
How are you?
you were upside down and now you're right side up?
I know. iPad training.
Is manufacturing a mortgage. We look, just take an underwriter today. Underwriters pre-pandemic were in the sort of 80 to 90,000 range, maybe even down in the 70s, depending on their, what they could do. It really ramped up into the well above 6 figures. And even if the market slows down, even if the job market becomes tougher for underwriters, it's not going to go back down to pre-pandemic. It's going to come down possibly a little. So at the end of the day, our manufacturing cost is going to be higher. We do have bigger loan amounts, but if the volume constricts, we're working with the same kind of dollars. I feel like we're behind the 8 ball as a company with robotic process automation, with AI and outsourcing, but we have been making great strides in that direction. And I can tell you what I've seen personally is that outsourcing is the fastest way to reduce those costs. It's just the hardest way to incorporate into your culture. It's the hardest thing to incorporate in your culture. When someone looks at RPA, robotic process automation, they think, oh, this is going to make my job easier. Some people think, oh, it's going to take my job, but really, they're really hard to deploy and hard to manage to because they break easier. But when you go to nearshore or offshore, outsource, people are more worried about the job, the quality, compliance, et cetera. And so I think that really creates rifts in the culture of a company that you have to overcome. And that's for me the hard part. But right now we have about 50 employees in Mexico. That's where we're going. We have branches now that will have 1 staff member here and 5 staff members, 3 staff members there. And we're continuing to move as aggressively as we can in that path while we're deploying robotic process automation that will hopefully give us some reduction or more increase in productivity. But there's really nothing in terms of RPA and AI. I love them. We embrace them. That will take a 1-for-1 $5,000 cost to $1,500, where you can train and move that in about 90 days. So, that's where we're at. If we can drop our manufacturing costs another 30, 40, hopefully 50 basis points, if that's even feasible for us by the end of the year, next year, that's where we're going. That's what we're thinking about. That's how we're planning.
Yeah, you mentioned the cost of underwriters. Just looking through my notes as you were talking about it, TMC Benchmark, our benchmarking tool for our network that a lot of the members participate in, average national cost of an underwriter annually. We saw it during the pre-pandemic. It was in the low 80s, went as high as 95,000. It's back down now into the high 80s. But yeah, it really, it's very expensive. And you mentioned like the technologies that are starting to emerge out there. You're involved now with our emerging technology fund, and even the best are still imperfect. And they're getting there. You can see the progress that's been made these last couple of years, but you mentioned it, you know, that you have to teach them, you have to fix them. They're not easily applied amongst sometimes channels or from one mortgage company to another. I think you'll see a lot more progress in that area over the course of the last year, but lenders like yourself, you got to be thinking right now about the ways to lower your manufacturing costs, because just the sheer amount of people that refinanced in twos, and what that is going to do to the available pie of business, regardless of what happens, it's going to impact margins. And, you know, to a large degree, the lenders that make the right decisions today on ways to change it and automate and reduce the costs in their process will be the ones that are best positioned to grow as we look back on things a year from now.
Yeah, I love RPA and AI. I think it's the way to go. We're incorporating it in what we do. I think for the industry, most of the sort of tech-enabled features that have come out and that are very good live on the front end. They live on the POS side, on the origination side. They don't really live well in the manufacturing after the loan comes, after the bucket is filled with something. That's where it's highly needed, and it's imperfect. But you're right, a lot of great strides. Again, we're incorporating it along with AI, but bang for buck, it's outsourcing.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by the CEO of Panorama Mortgage Group, Jason Madiedo. Jason, another question that came in the Q&A. Do you think that construction loans will increase if the lumber prices continue to go down? And I mean, we've got to be building more homes. There's so many impediments to that right now, but how are you looking at the new stock side of our business right now?
So I don't know if construction loans, if they mean like actual like construction to perm or construction loans to builders. But I think if lumber prices continue to go down, I think builders are going to absorb that in profits because they've been getting their butts kicked. They started building a project, you know, however long ago, and bought the land, set the price, pre-sold the home, and now their lumber costs are up 30-40%, and their profits are down 30-40%. So I'm assuming that's going to be somewhat absorbed in their profits to bring them back to normal. But I don't know in terms of like 203K or construction or what type of loan.
Jason, another topic I wanted to hit on with you, just minority lending, non-white lending in general. I don't know of any company in America that does more of it than Panorama. You guys have entire divisions devoted to different ethnicities and have really been leaders in this space for a long time in the mortgage industry. A lot's starting to change in this space now, with Biden being such a high priority of the Biden administration. We all saw the ruling in New York, beholding IMBs to CRA guidelines. CFPB came out about a week ago and mentioned that they were conducting just an internal review of all this HMDA data that they have from lenders like yourselves, and ways that they can use it to analyze business practices of lenders. Your thoughts on just diverse market lending in general, and you know, how the Biden administration is approaching it, and maybe some things to look out for in that arena as we head into the new year.
Yeah. Wow, you covered a lot. So on the CRA side, I don't know how that's going to be really deployed, because CRA itself is all about taking deposits, and IMBs don't take deposits, and that's how that's really measured. And so, you know, they have to come up with, and I don't know what if they have a whole new benchmarking or metric way to measure IMBs, and that's going to be, I think, difficult to get really all the way across. But it doesn't matter for us. We're passionate about the underserved markets. I can tell you that when you're in minority lending, it's tougher when prices are going up and interest rates also go up, because affordability is everything in the underserved markets. But at the same time, look at any report, and 50%, a third, a third, 50% of the first-time home buyers are people of color. So I guess I've always joked to every other mortgage company, don't worry about the minority market. We got it covered. Just, do something else.
You always make the more white person loans.
But, speaking of manufacturing and underserved markets, understand the product, understand the manufacturing, understand the dynamics of that familial profile. If you're not doing a lot of government lending, maybe you want to bulk up on your FHA underwriting, on your processing. I think the other is really dealing with the high touch of working with first-time home buyers, underserved home buyers. There's a difference between minority home buyers and non-minority first-time home buyers, and this is the one difference. When you have a non-minority first-time home buyer, they typically have family members and or generational wealth of some sort. I'm not talking about rich. I'm just saying some sort of handed down wealth that is a support system for that first-time home buyer. In the underserved market lending, they don't have that. They may have had, they're probably come from generations of never owning, always renting. No generational wealth, no support system. So it's a different consumer, and that support system has to come from companies like ours or all the mortgage people that are on the call now. It makes it more high touch. I mean, we've clearly seen from 2020 to now 2021, our per loan per LO has really went down, and obviously refi is one of those, but we also deal with a higher touch consumer. So I think what I would say was be prepared product wise, passion wise. It starts from the top of wanting to serve. You got to want to serve, and the mortgage just sort of happens because of it. I think that's sort of how you would approach the underserved market.
That is outstanding advice and insight to take us home in the first session of the 12 days of TMC. And you can see now why we picked Jason to be on it with us. And Jason, appreciate so much everything you've done for TMC over the years. Your fingerprints are all over our organization, and always enjoy talking about the business with you.
Thanks, Rich. All right. Thank you for having me, and have a great next session.
Yeah, and coming up at the bottom of the hour, good segue, we have the Associate Acting Director of the CFPB, Dave Uijo. So hopefully we'll provide some additional insight on some of the topics Jason and I were just hitting on. Want to really thank everybody for joining us for the last week in mortgage. We're here every Tuesday at 2 p.m. Eastern, including the next 2 Tuesdays as part of the 12 days of TMC event, and really appreciate you making some time for us. So enjoy the next session, enjoy the next 12 days, and Jason, great seeing you, bud. Take care.